Pre-approval, in my opinion, is the single most important piece of paper to obtain before you start looking for a home, because that assures you as a buyer a bank is ready to stand behind you and give you money when the time comes. The pre-approval letter pretty much states, the bank has viewed your credit, looked at your assets, and looked at your income. And those are the three main pieces banks look at when they're giving you money. So the pre-approval assures the buyer that they can actually get a mortgage when the time comes. The numbers are pretty black and white. They're going to say our debt to income ratio is 50% of your gross income. Now, that doesn't mean if a bank approves you for 50% of your gross income on your mortgage payment, you should go out and spend up to 50% of your mortgage payment. As a matter of fact, I highly advise you not to do that. I think the average rule should be 28 to 35% of your gross income for all of your debt. Just because a bank approves you, you should not over leverage yourself and go to the max capacity that the bank has approved you for. But that pre-approval does give you a good sense of what you're able to borrow, and that when the time comes, the lender or the bank is ready with their bag full of money, per se. A pre-approval does expire. Every pre-approval with every bank has an expiration date, because you remember, the bank is running a credit report. That credit report is usually good for 3 months. So every 3 months, the mortgage banker, the loan officer, they're going to do that review again to issue a new pre-approval. So it is important to constantly update the loan officer you're working with, especially when you get closer to that 3-month mark.